Welcome to SmithWeekly Discussions, an occasional program for our members of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine our show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion today, we want to say thanks for questions coming from our audience of SmithWeekly, including Sean M., Joe G., Paul M., Gabe F., and Mark R. On the program today is a returning guest back to update. Mr. Scott Melbye is back with us. Scott is the president and CEO of Uranium Royalty Corp. The company is focused on building a portfolio of royalty and streams with uranium assets globally, with flexible financial model to assist companies towards production in the form of royalty, stream, offtake, equity investment, physical lending, and conventional debt instruments. At this time, the company is the only pure-play uranium royalty and stream company in the uranium sector. Uranium Royalty is listed on the NASDAQ under the symbol UROY and also on the Toronto Stock Exchange under the symbol URC. Scott, thanks for coming back on the podcast. Welcome.
Andrew, it's always great to be with you. These are exciting times, so lots of things to unpack.
Definitely exciting is probably the best way to explain, of course, both the positive and negative pieces of everything that we're seeing out there right now. In the broad market, I guess we'll start there, let alone just the uranium market and, of course, fuel cycle. Good to have you back, Scott. We should probably start off here by talking the uranium market and, of course, sentiment for the juniors out there. Do that first. What do you see it and hearing out there so far this year? You know, we're a couple months in here, and what are your expectations for the uranium market in 2025?
Well, yeah, it's we have an unusual situation, and having come off, I think the first part of every year is kind of conference season where you're at PDAC, BMO, Roth Capital, and so coming off of a lot of discussions with investors, both retail and institutional. And, we have a situation where obviously you have broad market risk off anxiety with tariffs and other sort of recessionary fears. Uranium stocks haven't been spared that pullback, but we've been hit even harder than the broader markets from what I call a series of kind of false narratives. And maybe it's when investors are in a risk off mode, they're just looking for reasons to sell their uranium equities. But, one by one, a lot of these market scares have proven to be, non-stories or fake news. So, I mean, you had the DeepSeek hit, which kind of cast doubt that, the AI boom will be as big as it is, and data centers won't be built as fast, and nuclear power won't be called on to power those data centers. We found that's just not to be the case. I was in CERAWeek in Houston last week and literally met with Amazon, Google, Microsoft, Oracle, all these tech companies and the hyperscalers and the companies that are in that ecosystem of providing power to those data centers, and the capital spend hasn't decreased a bit. It's full speed ahead. I think you had some other scares that maybe Trump will pursue kind of a weapons dismantlement deal, and a couple tweets that kind of triggered some conversations on that. I mean, the U.S. doesn't have excess warheads, or Russia for that matter, like was the case in the 80s and 90s. China's increasing their arsenal. So I don't see any appetite whatsoever for the U.S. Or Russia to engage in that. And then perhaps the most kind of more material, I think, would be fears that if there is peace achieved in Ukraine, does that impact Russian sanctions in the U.S.? Could it cause the uranium ban to be lifted? And on that one, I mean, I can say as head of the Uranium Producers of America, the reason we put that, enshrine that in legislation rather than leave it to an executive order, so we didn't want it to be undone with a stroke of a pen by either a Republican or Democratic president. To unwind that would require new legislation to be passed on a very busy legislative calendar where there's not a lot of room to put something on, especially a bill that a congressman would have to vote for that benefits Vladimir Putin and at the expense of uranium conversion enrichment in the US. So that's not going to happen. And I don't think Trump would want it to happen given the energy dominance theme that is the energy policy now. It's not about relying on foreign countries or adversaries for our energy. It's more domestic production. So I think a lot of these things were weighing on the stocks and the spot market. I think the one thing you can point to in the spot market that is legit was this liquidation of the ANU inventory that came out of Kazakhstan. It was really kind of a start and stop effort by the Kazakhs to sell this 2.6 million pounds of inventory that had been acquired to be put into this fund listed on the Astana exchange to kind of be another alternative to Sprott Physical or Yellowcake. The way that was sold ended up being very awkward, and those pounds have been splashing in the market now since November, December. So if you're looking for a real reason why the spot pulled back to 63, 64, that's a good one. But the good news is it's finite, and I think we're probably seeing the impacts of that passing. The other thing you have to point to is you can't have a $64 spot market and an $80 long-term market and have that persist for long. And the fact that there's not a lot of volumes available and trading at the $64 range tells me that that spot price is going to not only increase to 80 where the long-term prices are, but I would expect it to go beyond that. And the reason I say that is I think utilities are going to come back to the market for long-term contracting in 2025 and find that they have very few options. There's not a lot of uncommitted producer supply that can be put into long-term contracts, and those that have pounds to put into contracts are probably not looking to fire sale that. They're probably looking at 80 or even higher in a base escalated contract. So the utilities faced with having to accept signing an $80, $85 long-term contract in the face of a $64 spot price. And I think, if they're not willing to sign those contracts at those levels, their only option is to fall back on the spot market, and then the spot market won't be at $64 anymore. We'll see, any amount of demand hitting that market right now. We'll have that price back up above 70, 80, even 90. So I think we just have to let it play out. We know that the utility demand is out there. If they're holding their breath, it can't be for long. There's a lot of demand that needs to be fulfilled out there.
Scott, thank you for that. That's lots of good information. And when you look at these deals, and you're not able to have a conversation in the 80s and 90s with the utility, well, like you said, it's such light volume that's moved downward the spot price, and there's almost no material out there. I mean, there's certainly small quantities, which provides a great opportunity for some of the groups out there, which we'll talk about. Everything here is just have some patience. Make sure you keep your solvency. Fairly straightforward stuff. It's not the first time we've seen these types of delays and these inactivity and sentiment go down the toilet. We've seen this happen before, Scott, as you well know. You've seen it plenty of times in your career in this industry. And to see a ban lifted immediately upon some type of a brokered deal for peace in Ukraine, unlikely that that would happen. I don't profess to be a geopolitic expert, but certainly even if it did happen, which is unlikely to happen immediately, I'm still putting together the big question mark of, even with that lifted, how does this play out for our thesis overall in the fuel cycle? And it doesn't really change much. I mean, yes, there is the potential for some delay. There's some potential for some manipulation work and a little bit of things there. But generally, there's still a big domestic problem in the United States. There's a Western supply chain problem, period, that needs to get fixed. And then it doesn't also solve issues with existing mines. I'm not seeing a lot of mines coming online on time, on budget, at the production numbers that we're expecting by now. All of this stuff's terribly delayed. Some of it may never get to where it needs to go. And we've already gotten plenty of examples. And I think it's pretty safe to suspect that even the new stuff coming on and the future restarts, they're all going to be severely challenged, because the last few we've seen, Scott, they've all been challenged substantially and continue to go through challenges. I think that's an indicator of where we're headed here at further bottlenecks.
We're finding that, globally mining is hard, and starting up new mines from a greenfield is especially challenging. But even the low-hanging fruit, which is the restart of existing mines, whether it's been Langer Heinrich, Boss, the US mines, that's the easy stuff. And that's been slow to ramp up. I think those producers are going to overcome those early startup and ramp up. But the mines in the U.S. are going to produce 1-2 million pounds each. We need 5 or 6 additional mines by 2030 to come on, and those are either new startups or in regions of the world. If there's additional production coming on in Kazakhstan, I'm not sure it's of any benefit to the West. We see Russia and China largely controlling much of that output for their own needs in this market bifurcation. I don't know where there's a commodity out there where the world's largest producer is not available to the West. Over 40% of production largely being consumed by Kazakh neighbors, Russia and China. So we need new mines in the West. That's really good for the United States and Canada, which has the ability to ramp up dramatically, and Australia. And I think parts of Africa, as you know, it's a bit of a resource competition on the African continent as Russia and China also want to increase their influence and control there. But again,
Right.
is very bullish on prices. And don't forget, demand is, meanwhile, while we're looking at new production struggling to come online, demand is now set to double by 2050. And then, of course, you have the aspirational goals of tripling by 2050, which I think can be achieved with the data center demand on SMRs and the new build that likely comes on in a big way in 2030 onward. But we're beginning to see the first of a kind SMRs come online shortly before that. So incredibly bullish outlook. If your favorite uranium stocks are on a 30-40% discount right now, that's a screaming buy signal to add to positions or establish new positions. It just I've never seen the fundamentals this positive.
Absolutely. And URC would be one of those companies to probably take a hard look at for some of those investors out there. And I'm sure there's folks listening in that do have the equity already and are probably looking to add to their position or already have, Scott. So I appreciate your comments on that as far as, how things look on the sentiment side of things. I think the other thing to layer on here too, while uranium domestically in the US doesn't necessarily have too many problems from restarts, and certainly projects in the proper jurisdictions to actually get going or to get permissions from a permitting standpoint,
Mhm.
is what I mean there. That is not generally the run of the river in the sense of generally in the US, environmental and climate change and carbon footprints are holding up mining projects from being brought in, whether it's a copper mine of size and any kind of critical minerals, generally still, while the air has changed direction a bit, there are still a lot of hurdles on the permitting side of things. And it seems like even though one side may be talking positive, the backside there still is holding things up, and there's a huge bottleneck just on permitting. And I guess people just haven't felt the pain enough yet to start figuring out that you've got to start to look at proper policy and proper energy and natural resource independence. And I think we're getting there. It's just painfully slow. And folks, of course, don't want to get off some of these narratives that, of course, continue to prevail.
Yeah, that's a great segue. We do have a new administration, and I had the benefit at CERAWeek of attending a very small group. It was about 7 or 8 of executives from the largest global mining companies and those active in the United States. We sat down with Secretary Burgum, Department of the Interior, where he heard a lot of the issues with copper mines in Arizona. I obviously spoke to the uranium situation. We have 6 U.S. Producers in the Uranium Producers of America group that have restarted production, but that's from existing mines that were already permitted and they had the ability to move forward. We have a whole host of other members that are going through that development permitting stage, and they're the ones that can't afford to go through 7-8 year permitting timelines. And I think the fact that Secretary Burgum seems committed to get uranium on the critical minerals list again. It was on the list in the Trump first term, taken off by Biden. And in Burgum's words, it's not just drill, baby, drill when it comes to mining of critical minerals and energy minerals like uranium. It's mine, baby, mine. And I think we have a very receptive administration, not only on the mining side, but also on the energy side. The Energy Dominance Council that's being established, and the energy dominance policy that Trump has put forward, which means the US is going to produce enough energy to not be reliant on foreign countries for our energy needs, and will produce enough to be net exporters to friends and allies in Europe and Asia. And I think along the lines, if there are barriers in the electric sector, this is really going to call heavily on natural gas and nuclear. And I think coal plants will be slow to be phased out in this policy. But we need to do this because we now have demand load growth in the United States like we haven't seen since the early 2000s. And it's not just data centers, it's electric vehicles, it's electrification of homes and businesses. We need to build baseload generation again. We don't break down the bottlenecks in natural gas of drilling, building pipelines, or in the uranium and nuclear sector permitting SMRs. Why shouldn't they be permitted in 2 years as opposed to 8 or 10 when these are fairly simple? They're cool science, but they're not particularly complicated or have a lot of risks like that would have them be um, adhering to the regulatory guidelines for a large 1,500 megawatt reactor. So I'm optimistic that on the energy side and on the mining side, we're going to have a very friendly administration in the Trump White House.
Yeah, that sounds pretty good there, Scott, and I hope that does come through in full as we expect here, and they waive some of these stupid formalities, which are just completely silly, Scott. I mean, it does not take that type of time frame to approve any of this stuff. Um,
Yeah, the abuse of NEPA, for example, is just that's been the card that environmentalists play to shut anything down from moving forward. And we have an energy crisis now. If we don't get this energy online, we're not going to win the AI battle with China, and we'll literally have blackouts in the United States now with the load growth that we're seeing across the country. So, yeah, thank
it's
God we have a pro-energy White House.
you guys won't have too many blackouts where you are, Scott, because you guys are enjoying the coal power and everything else that Colorado still provides. Which, look, it makes sense. You don't shut down good operating facilities that work and provide that base load. The other thing is too is the U.S. has been so starved of infrastructure maintenance. It really has. The infrastructure maintenance, especially on energy, has been neglected. It's been just screwed over the years. In addition to, of course, we can even get into topics like water, which also have huge problems because of just simple policy failures and this big bureaucratic hold everything up on permitting. So I hope those formalities get waived. The cleaning that needs to happen in some of these agencies needs to happen. You really got to trim the fat here. It's just so horrible what has happened. As a result, the U.S. is losing its edge and has been doing so for years. So hopefully here we see some good sound turnaround. Looks like that'll happen. I think you covered off here that basically the incoming administration will be much more proactive towards proper energy than the last administration. And then also policies will hopefully go into place to promote domestic source, supply chains, mineral development, and of course, independence on energy as well. I guess on another thing here, we talked Russia and how that would possibly go. Any other things on the US side that you're hearing? And I guess before I jump internationally here, let me just ask you a little bit about when you're talking, Scott, to US utilities, which I know you keep in touch with frequently. Specifically at this point, how are utilities feeling in terms of awaiting policy decisions from the new administration, how they're looking at their needs in the immediate term based on they don't know exactly where the policy is going to be. So therefore, obviously some utilities are better off than others, but hey, there's not a need to secure material immediately because we need policy decisions. What are you hearing out there as far as US utilities specific?
Well, I think it impacted the long-term contracting last year. In the previous year to that, we saw a more normal replacement rate of long-term contracting. Last year, it fell off, and I think in 2025, that's got to pick up because it just those needs need to be filled. I think with the Russia ban coming into place and some uncertainty as to how the waiver process would play out did kind of freeze out some of that activity. Listen, however the waivers fall between now and 2027, at the end of that year, Russian supplies we're through with that Russian reliance, and in our planning horizons in mining and nuclear energy, that's practically tomorrow in terms of where people are contracting forward. I think we also saw something that was a bit alarming with the spike in Chinese imports into the United States over the last year and a half, 2 years, that really occurred at the same time that you saw an abnormal and unusual spike in Russian EUP going to China. And it looks a lot like displacement swaps and circumvention. And I know Congress is very concerned about that, to get us off a Russian supply addiction and then to fall into a reliance on China is just something that no one on the Hill or in the administration want to see happening. So, as we're talking about, you know, musing whether the Russian uranium ban will go away or not, I think it's more likely that the Russian uranium ban is expanded to include China. And that could happen in this legislative session, even. So, something to think about. But again, these are policies not meant to punish or harm the utilities. It's meant to really provide the stimulus for supplies in the United States and more broadly, Western supplies. The topic of Canada comes up obviously with tariffs. The whole tariff discussion with President Trump is at a much higher level. I don't think he's thinking about uranium when he's engaged in those discussions with the Canadian government. But I think a robust North American industry, and that includes supplies from Saskatchewan, are a good thing for the United States. Provides energy security. Now, I don't want to see the U.S. not supplying any of its needs like we've seen in recent years, but I'm seeing the positive steps amongst our member companies that are bringing uranium production back online in the United States. And I think looking forward, Saskatchewan over the next 10 years probably needs to double production. And you obviously have projects in the works. I mean, I don't think they'll come on as quickly as many expect, but as Cigar Lake and McArthur River are playing out, towards the end of their lives, we're going to have new mines coming online in the 2030s to replace that. That's all very good for North American energy security.
Key piece there, 2030s, and definitely you and I both know that there's a lot of these projects that just where they stand today, we know that they're not going to be there as far as some of the ones that are depleting, but also the new ones. We know that the time frames are well extended, and that would be extremely likely to see any essentially tier one asset of significant size in the proper jurisdictions actually come in this decade, definitely the 2030s at this point. And there's a number of reasons why that's not going to happen. Just with respect to some of the tariff activity out there, and when you look at some of the targeted areas for tariffs, it is indeed going to be painful. And that also that in order to boost that domestic rejuvenation, I guess, of those supply chains, you have to have these types of policies. Let's talk domestic steel
Mm-hmm.
manufacturing capacity. It's very challenged. And therefore, when you buy domestic, it's terribly expensive because there's just not a lot of supply out there. So infrastructure, look, we all know that the tariffs for economic activity, tariffs aren't necessarily the greatest thing, and that the economy will be challenged here going forward, which brings in potential concerns with the broad market and interest rates and all the other things that are playing into that as well. So we do have that angle to add as well. I want to change gears for just a moment. I want to get your thoughts on Niger. At this point, we've been able to see the last couple of years, we've seen it fall out of place as far as a historically reliable source in the past for uranium supply. We've watched a number of events unfold that have contributed to that falling out of its position, including the likely exit in full of the French influence there. Niger was a on the table supplier and a reliable supplier last cycle. What do you think of future production there, Scott? And does the place interest you from a point of value and deal perspective?
Yeah, it's very interesting. We know that it was supplying over 20% of French supply for many, many years. For my entire career, it's always been Sominac and the mines, the French mines there. But with the military coup and expelling the French. A little surprised that they expelled the U.S. from the base there. Really, I think from my company's perspective, we were really risk off at that time. But I'll full disclosure is, I think we're open to seeing now 2 or 3 years later, all right, this is the new government. Governments change in Africa. They're not always, the democratic models that we might like to see in the West. But I think it's as investors, we need to go and look at every possible source of supply around the world and look at it. And I think we're willing to give it a fresh look. It seems that the government has been very supportive of Global Atomic. And I have to say, Steve Roman has done an amazing job in building that mine under the most challenging circumstances where there were, border issues, where supplies were challenging to get into the country to build the mine. But Steve Roman he's persevered, and he's built the mine, and he's underground, and they've actually come across ore underground. So I think, like anything, we get a conventional wisdom on a project, but I think, that's a project that deserves a fair due diligence, because it might be one that, if it can prevail under those challenging circumstances, it might be one of the few, new conventional mines that could come on in the next couple of years.
I guess that leads me into my next question here, just as far as there's those jurisdictions and you've got those beat up companies for one reason or another, and let's not get
Mhm.
into the reasons. You and I would talk for the rest of the podcast just on that, but think about from the perspective of the investor for a moment, Scott, because I want to hear from you on this, because I know you think about these things. And when you look at all the dynamics going on in the fuel cycle and on the uranium end of things, you have jurisdictions like Niger that are beat up and the equities associated are beat up. And then you have other jurisdictions where the equities are more stable, for example, and you have, producers, you have the development companies, large scale developers, maybe in Namibia, and then also you have the restart ISR end of things, and then you have the little juniors, which have gotten beat up generally, and then you have broad market factors. And where sentiment lands in those different categories within the sector, where do you think an investor is best served when looking to deploy capital? And don't say URC, that one's off limits.
No, I think I've always said that, I'm not against investing in early stage exploration companies. That's the equivalent of the, pharmaceutical or biotech investments, where you put money in there. If it hits, you have, a 10 bagger. If it doesn't, you lose everything. And that appeals to a lot of investors. I, in my own personal investments, like to be kind of targeting who are those companies that have the assets, the management teams, the right political risk jurisdictions to be able to produce and cash flow in this cycle, which I think is going to be a very long, prolonged upcycle. This is going to be not the flash and crash that we saw last time, because we have a lot of mines that need to be built in this period. So it's, and that's really my role at URC as well, is to look at the universe of mines in Africa, Australia, US, Canada, and assess which one of these companies or groups of companies are going to be the ones that have what it takes to be a producer, to be one of those 5 to 6 new mines that are needed by 2030. And we're willing to put capital into those. And I have to say, with this pullback in the equities and the pullback in spot price, URC has never been busier in terms of our pipeline of new business development. And if you think of it logically, we have a number of potential producers out there that are developing mines and moving them towards production. And maybe they're, halfway through that journey, maybe they're 3/4, maybe they're almost to the point of bringing it over the line and bringing it into production. But some of them have capital needs of 20, 30, 40, 50, $60 million to get over that hump and into production. Well, if your share price is trading at a 52-week low, and that option is not as attractive, you don't want to dilute your shareholders and raise that kind of capital, but you don't want to delay the development of the mine or inhibit that startup timeline. Suddenly a royalty and stream financing looks very attractive. You don't have to encumber many pounds in the future in a what we think is a 80, 90, $100 uranium market going forward, or even higher, you don't have to encumber a lot of pounds to get 20, 30, $40 million of capital today to get that mine over the hump. So I can tell you we're in multiple discussions along those lines, and it's something we, as a company, I enjoy it personally, being that sort of problem solver. But we have a diverse portfolio. We have 24 royalties on 21 projects. We want that to be 35 royalties by this time next year. We can take a little bit more risk. As a royalty holder, we have a portfolio approach. It's diversified. Some of our assets are going to outperform expectations. I'm sure some are going to disappoint, but it's not like if one of those has a blow up, it's not going to bring the company down. So we're quite eager to be that investor in those mines that'll be the ones that help close this gap in the coming years.
Thank you for that, Scott. I think that provides, investors and folks listening in here kind of where they should maybe look at, perhaps take a blended approach on a few different areas here and be careful with some of the troubled jurisdictions. And obviously, we've had challenges there, and those tend to prevail longer than a lot of people can consider. I'll use Sudan for an example. Sudan's just the time frame has taken way longer than people ever expected. And I'm not saying Niger is that way, or maybe the next jurisdiction that'll come up in the years ahead. There will be one or two for sure, but definitely these things take a lot longer than investors normally can have patience for. And so there's always that consideration. And then there's the more stable ones like URC. I'll plug it for you, Scott. URC is something to consider. It's part of that overall strategy. And URC has a very good balance, like you said. Some of your stuff's
Yeah,
going to
I mean,
outperform, some
we
of your stuff
are.
may come up short.
Yeah, and I mean, we are not by design, but it's just worked out that way. We are overweight in North America, which is not a bad thing in terms of ISR in the US, conventional exposure in the US, and then exposure up in Saskatchewan. That's a good thing. I think just as an objective, I want to be more balanced globally, hence why we're looking in Africa and Australia to add a little bit of geographic balance there. But, it does, when you look at the regulatory environment in the United States, especially with agreement states like Texas and Wyoming, where it's predictable. And as investors, you want to deploy capital, but you just don't want this ended liability of, well, how long is it going to take to permit and bring on a new mine? Well, you have that kind of regulatory certainty in the U.S. I think Canada, not quick or easy, but if you follow all the steps, you'll get your permit to mine and move forward. Of course, you've got to ensure that the First Nations are on board. That's always a factor. But Saskatchewan, those relationships have been pretty good. They've managed the First Nation relationships really well and shown that the local communities can benefit as much as anyone from that development. So, yeah, jurisdictions, it's very important. And I think in a bifurcation of markets, the world's largest producer, Kazakhstan, is largely going to go to Russia and China. That's not for us in the West. So it's interesting. We hang on their production versus guidance every quarter. We hang on the sulfuric acid situation. But, if none of those pounds reach the market 3 or 4 years from now, it's academic. It's more important to see, okay, what's happening in Africa, Australia, US, and Canada.
Very good points there, Scott. While we're on that bit, I want to just jump to this now and ask you, just talk briefly about, okay, so you're overweight North America a little bit here, and that gets me into what I wanted to ask you here later. But just talk about the deal table in terms of what types of royalty stream deals you have most interest in, if not all of them at this point. And then remind us again of the dollar size range that you guys would consider. And then last, specifically, if you could take on more jurisdictions, maybe give us a little bit of enlightenment as to what jurisdictions you would like to increase deal flow based on how geopolitics have played out so far this cycle.
On jurisdictions, I think, Africa, you've just got to take it country by country. But I also think it's important to go to those countries and do the due diligence and see, because sometimes, we tend in the West, we draw conclusions about countries or governments. And, I think, that, I mean, this is what people should be relying on us at URC with our decades of uranium exploration, mining, marketing and geopolitical experience in this business is to go into those countries and really see, if they're investable or not. The deal size, we've been acquiring existing royalties, for 3, 4, 5 million. Millennium was our latest acquisition, which is a great future development for Cameco. These tend to be those smaller ticket size. The new financings are coming in at the 10, 15, all the way up to 50 million. We're looking at a project that has a total capital lift of probably 160 million to get the project brought forward. But we obviously would only be looking at taking a small bite of that. So yeah, I mean, it's we're seeing everything from new mine startups where we're funding the mine development. We're seeing great opportunities in byproduct where uranium is produced as a byproduct of copper, nickel, gold, and has small amounts of uranium, which is advantageous for those producers to have that removed from their product stream or even remove it from their tailing stream. We'll go in, provide financing to build the uranium circuit to take that uranium out of their main commodity focus. And it presents a nice opportunity for us. It may not produce a lot of pounds, could be under 500,000 pounds a year, could be 100, 200,000 pounds a year. But, with a small uranium circuit that we would finance and fund, those deals make sense. So we're being very creative. We're overturning stones everywhere we can and using those decades of experience in the uranium business to find those opportunities and hopefully land them in our portfolio.
That's always good to get your insights on this because you're actively looking at all these jurisdictions and also considering deals for the company here. And obviously, you got to be selective, and that's worked out to be okay over the time frame here because this market, it takes time. And certainly, I think in 2017, 2016 period, a lot of us probably thought out and maybe couldn't quite comprehend it, but thought out this market's got to move and be over with, by the early 20s or mid 20s, and here we are in 2025. So it's definitely taken longer than I think a lot of people expected. Even the proclaimed smartest people in the room probably are still scratching their head as to the length here, the duration of this cycle. And definitely patience has been part of it and lesson learning. And of course, we've been wrong on a number of things. Happy to admit that, unlike maybe some others. But we're happy. We're satisfied where we are. And we're going to continue to move here. And luckily, we're in a fairly good position based on some decisions that in part had to do with maybe just a good stroke of luck as well. Okay, let's talk a little bit about the Millennium deal and also the Cree extension uranium projects. So this was announced in October 2024. The company has acquired an existing royalty in the form of a 10% net profits interest on those two projects, which are held by Cameco. Just
Right.
talk a little bit about the transaction highlights for us.
These are the kind of things that you uncover. It's interesting. This interest was held by Linde, which kind of was acquired, I think, Air Products and kind of industrial gases company. We knew that they had this asset. It may have gone all the way back to Union Carbide, how it landed in their portfolio. But we had to go to the corporate development teams at Linde and actually tell them that they had this asset of which they really weren't that familiar with. And so being able to cash them out and bring that, into our portfolio is really a great move. I mean, it was very similar to the Cigar Lake and McArthur River acquisitions from Reserve Oil and Minerals. I mean, this was an early oil and gas explorer in the basin in the late 70s, early 80s, and being able to go in and acquire those royalty interests that they had and had carried all these years. That's where industry experience helps is to find those. And there are a number of other royalty interests, whether they're held by sometimes in family trusts, family offices that are managing for wealthy families that hold these interests. They're remnants of old M&A transactions, could be landowners, could be even First Nations tribes if they wanted to monetize a portion of their future royalty. If they have need to fund something in the community today and they don't want to wait 15 years to for the income stream to come in, we can come in and provide that solution. So I would just say it's a really target rich environment right now. And, a millennium isn't something that's going to cash flow tomorrow. But as, Cameco looks, at its next generation of mines in Saskatchewan, projects like that will really, figure in nicely. We have a royalty interest on Dawn Lake. That's the extension of the Hurricane deposit that ISO Energy, world-class deposit. Cameco isn't as open about their drill results because that's just not their style. But we know the Hurricane deposit doesn't stop at the borderline there. So those are royalties you tuck away. Again, they're not going to be cash flowing, anytime soon. But when you get out to that point, investors will say, "Geez, how did you have the foresight to put those in the portfolio?" The good news is, we do have a number of our assets. Recall when we launched the company in 2019, very few mines were operating globally in the West, and our royalty portfolio was no exception. But now, as we sit in 2025, we have visibility to about 10 million in annual cash flow by 2027, 2028, in that time frame, about 30 million by 2030, and about 50 million by 2033 from our existing assets. Obviously, the earliest movers are going to be the McArthur River, which is paying out over $1 million a year in physical uranium payments to us. Cigar Lake is a net profit interest, so it's still going through that expense bucket drawdown in our formula. But by 2027, 28, you see that kicking in at a really healthy 4 or 5 million a year. We have interest in Lance, which obviously that's been one of the slow startups, but as they complete a central plant and get that into production later this year, we have a full 1% royalty interest on that project. We have parts of the deposit where we have a 5% coverage. So Langer Heinrich's cash flowing under a small fixed royalty. So we're beginning to see the cash flow emerge, and the G&A and overhead for a company our size, that's not too difficult to cover the G&A with the revenue that we see coming online.
Good to cover off here, and I think the royalty that you were able to get there on the other side of Hurricane, where Cameco is certainly putting some drill holes. It's not material, so there's no reason to really report anything at this point. For them, anyway, it's not material. So I just think those types of things can make a lot of sense. And you being able to go out there and scratch up some of these and pull them together and put them in the portfolio is a very good move. And again, you guys have just done this methodically over time and built this portfolio up. I want to come back to some of the immediate or near term income items in a moment. But just on other news here, you guys also added on the staffing side late last year, you guys brought in Ken Robertson to the board of directors. Just talk about what he brings to the table.
Yeah, so obviously financial and accounting acumen on the audit committee, but has been involved in the audit side, the mining industry out of Vancouver and Toronto for much of his career. Really great addition. But we have a small team. We have about 5 or 6 people that can run this company. We can double or triple the size of this company with the team we have. But it's very important that the small team be a very experienced one. And so I rely heavily on on the technical due diligence, which is probably the most important thing that we do in evaluating which projects to pursue, and then what we should pay for a royalty when we identify a target. So Darcy Herscorn, with over 20 years of experience with Cameco global exploration, he'll scrub the project from the was the proper exploration regimen performed to determine the resource. And then if it comes down to assessing the mine plan, we have James Hatley, who is mine engineer at McArthur and Cigar, also at Cameco. We have a big Cameco contingent for a small company. That's very valuable insight. And then Catherine Arblaster, our VP of Sustainable Development, will scrub each project for health, safety, environment aspects. Are there First Nations issues? Because we do run the projects through that filter as well, and we wouldn't invest in a project that didn't meet kind of high standards in that area. Donna Witchers, who joined our board, who has been one of the most experienced mining people in the United States over the last 40, 50 years. So having her on board to kind of put, and we have a very active board where we will bring opportunities and ideas to them to draw on their expertise and kind of give them a heads up of what's coming down the pipe. And we really value that for a small company. It's nice to have an active board that can contribute in that way.
Thank you for that. That's good to see the folks coming in here and continuing to support your guys' vision for the company here. While we're on this subject now, why don't we just have a quick update on the capital structure, Scott, as far as where we stand today as cash on hand, the inventory of uranium on hand, and of course the shares outstanding currently at the company.
Yeah, so the cash balance right now, cash and liquid assets, I think we're about 270 million. There was a period here where, all the pullback that we were seeing in the uranium equities, I was beginning to wonder if our market cap was going to fall below our cash and liquid assets, and then investors could actually get our 24 royalty portfolio for free. But we've begun to kind of hopefully have bounced off the bottom. I think we're up 13% in the last week. But yeah, that cash balance is our war chest. We've parked much of that in physical uranium, which was really a smart move when we launched in 2019. We knew it was going to be a while before we set to see a steady cash flow. And so this being able to buy uranium at 20, 30, $40 a pound, realize that appreciation. And then as we need cash to close royalty deals, we'll sell uranium and fund those acquisitions. So I think we're at about 2.8 million pounds right now. Obviously, the value of those pounds have gone down at around $64, $65. But quite happy to have that war chest in our portfolio. Yeah, we haven't added. I mean, we have an ATM active, so there hasn't been any changes in share count. I mean, obviously trading at a zero point 0.5, zero point 0.6 discount to NAV, there's no interest whatsoever in adding share count, and I don't think we're going to need to. The average ticket size of some of these new royalty deals, it's nice to be able to fund that off the balance sheet and not have to go dip into the equity markets for that.
Given the cash balance too, you guys don't necessarily have to do anything in terms of financing unless there is something, some type of a deal potentially where you wrap the financing around it. So that sounds good there. So I think investors have a pretty good indication that you guys won't be doing much on that front at this point, given where you guys stand on assets on hand. Just another thing here, Scott, just to get a rough idea here as to how you guys are looking at physical material at this point for
Mhm.
the portfolio, with the light volume decline in spot prices, we've seen that occur. You've got this spread, of course, that opens up opportunities for traders and institutions to carry material and offload to utilities, or maybe drip it back into the market later on. Given where the company stands with its inventory presently, Scott, does it make sense at this point to consider small quantity purchases on spot to add to that inventory, or are you guys keeping your war chest for more better deals out there that you see maybe coming?
Yeah, as appealing as that would be to me, I would love to jump in the market and buy some pounds at these levels. I think we're actually kind of going in the other direction. I mean, that was a transitional strategy to buy physical as a transition period to the point where our royalties started cash flowing. So I think you have to think of us as, we were opportunistic. It paid off. We've got some nice trading profits on those pounds. But I think going forward, we don't want to be too heavily physically oriented. We're not a Sprott Physical Trust or a Yellow Cake. I would rather go the other way and reduce our uranium inventory holdings and invest those proceeds into new royalties and streams. I think that's where investors get the bang for their buck, at least under our structure.
Yeah, and I think that makes sense too, Scott. With that, obviously, there's the opportunistic portion where there might be an opportunity out there. If you guys do start to downsize that inventory, do you really see that your guys' first vehicle would be to utilize the market traders, the spot price, maybe some liquidity options to to move that out into the market, or would you, with your relationships out there, maybe do a couple small supply deals and wrap up that inventory?
Yeah, you've hit the nail on the head. With 41 years of selling uranium in this industry, just have a host of relationships and outlets that we can place material into buyers without negatively impacting the market. I think between my two companies that I'm involved in, I think over the last 5 years, we've acquired close to 10 million pounds, and we've sold roughly half of that. And I don't recall anyone ever kind of commenting that, geez, that's been a negative impact on the market, because we're quite savvy and sophisticated in the way we'll reintroduce that. We also have potential strategic partners that are eyeing that inventory, and there could be some strategic play done there to kind of turn those pounds to cash without just having to dump them on the spot market. That would be our least attractive alternative, unless, of course, the market is in a very strong period where there's a lot of activity in the market, there's strength in the spot market, and you could bleed a couple 100,000 pounds into the spot market without having any impact. We would do that. But our preference would be, as you've said, to utilize relationships to turn those pounds to cash.
Yeah, no, some type of a term deal that suits you guys and counterparty, where you don't have to utilize the spot market, and basically just do a label swap at the storage facility would be the best way to go here. So appreciate your thoughts on that. And it's good. You guys have some optionality here, and there's also those opportunistic events to kind of suck up a little bit of some of those light volumes that we've seen out there. Respect to that. And then also, of course, your relationships with utilities. I think that's a key feature also, and a key asset you bring to this company is those relationships as well, and how you can utilize those relationships for the betterment of the company. On the near-term income items here for the company. So you mentioned briefly Langer Heinrich, still in
Mhm.
restart mode, working out some of those kinks, probably for sure having some troubles on a few things. Then, of course, there's that lag time between getting from the gates of Langer Heinrich over to Walvis Bay. It
Right.
sits at the dock, it screws around at the dock, waiting for the next ship that can come out. Just talk about the timing as when you guys would see that first receipt of some payments from that income source, and then also maybe run us through just a couple other near-term income sources that you see might be coming in.
Yeah, so I mentioned MacArthur. We have been receiving book transfers of pounds to our account at Cameco. It's roughly been a little over 1 million a year. That will go up with increased production, obviously be more valuable with increased pricing. Mentioned the Cigar Lake, that net profit interest kicks in the next couple 3 years. Lance, it's very simple, 1 to 5% of production, the value of production there. So use your own assumptions on how that project ramps up. And then Langer Heinrich's very simple. I think it's a Australian cents per kGU. It comes out to a couple cents per pound U3O8. So yeah, there is some lag time, but I think we have already begun to receive revenue under that, or we're getting close with their ramp up over the last year. So that's a good one. You look at the value and you say, well, how do you get up to those bigger numbers when you get out to 2030, 2033? Take a project like Rough Rider, which, UEC has performed an economic study that showed that this can be a 6 to 7 million pound a year producer with $20 all-in sustaining cost, about 5 to 600 million capex to build. We have a 2% gross revenue royalty on that project. So what's the value of 7 million pounds in a $100 market? And 2% of that, you begin to see, how these royalties add up as mines come online. So it's steady cash flow. I mean, that's pretty good revenue growth. If we did nothing and we just sat on the existing portfolio, it would be decent revenue growth. But that's not the case. I think our number one priority is to grow the portfolio, get re-ratings as we add royalties to the portfolio.
That sounds good. Well, looking forward to seeing that start to ramp up here, and I think definitely we're on track to see that start to happen. And of course, you guys already have some payments coming in, Scott, which for your small office staff, it certainly helps with the G&A side of things. And then, of course, it's going to ramp up here as we continue down here in the cycle and some of these assets come back online, or, of course,
Mhm.
get some of the kinks worked out of them as well. So, appreciate the thoughts on that and definitely getting closer and closer to that increasing revenue coming in for the company here. Well, Scott, that was pretty much all I had there on discussions. Any other topics you wanted to cover before we wrap up here?
Having come off a number of investor conferences, as I said, both retail and institutional, it's easy, to kind of get caught up in the pessimism, but we're all investors and we're all in this to make money. I look at where the uranium equities across the board are trading right now, and I think there's an incredible generational wealth is going to be um, uh, achieved here with investors that have the savvy to say, okay, the fundamentals of our market look great. Yes, there's some broad market jitters and risk off, but those that are adding to uranium investments at these levels, given where this industry is going. I mean, I don't think we've fully grasped the growth of nuclear power as we head into the 2030 onward, and that's going to need a lot of uranium mines. And the sort of supply deficit that we're going to see between now and 2030 is going to point to higher uranium prices, and a lot higher than $64. In fact, I think uranium prices will trade above $100 per pound, before too long. I mean, that could happen quite quickly as buyers come back to the market and find that the long term supply is largely committed, and maybe the spot market's the only alternative for some of these utilities that haven't covered their needs as well as some of the others have. So I think they're exciting times for uranium. URC is a great model. It's a little bit different than the straight equity. It's different than physical uranium ETFs or the ETFs themselves, but it has elements of all of those. So I encourage you to take a look at uraniumroyalty.com and take a look at the portfolio, and certainly available for your listeners as well if they want to reach out to me.
Scott, thank you for that. And that covered up my last usual question there as to why folks should consider investing into the company today. It does have a market cap of about 260 million US dollars. And I think you just covered off why folks should consider it, whether you're retail, institutional, or family office. Very much interested to see what happens here going forward with it. And very good points you brought out today as far as the sentiment and the opportunities out there, the way you're looking at this market going forward here. So, besides the website, is there an email that folks can reach out to you on or to reach the company?
Yeah, you can reach me at smelbye, SMELBYE at uraniumroyalty.com. We're not so big that we can't respond to everybody's questions. So reach out to me, and happy to get back to you.
Scott, well, I appreciate the update today. Keep up the efforts over there. Looking forward to seeing more progress on the uranium royalty front and talk with you later on this year.
Excellent. Thank you.